This week, I want to highlight the power of ratio charts and how they can help identify major trends. A ratio chart compares the closing price of one stock or sector to another. When the chart trends upward, it indicates that stock 1 is outperforming stock 2. I use these charts to spot pivot points and identify long-term trends, sometimes lasting months or even years. You might assume that a bottom in a regular price chart also signals a pivot in a ratio chart, but that's not always the case. Let's explore some compelling examples. European markets. Financial services versus Stoxx 600. This sector continues to show strength. The chart underscores the importance of past turning points. Equal weighted versus cap weighted Stoxx 600 index. This chart highlights the significant gap between large caps and smaller companies. Utilities versus financials. Currently testing levels near the 2018 bottom, an area that also aligns with the 2007 breakout. Food and beverages versus Stoxx 600. Testing a key 20-year support zone. If this level holds, it's time to keep a close eye on stocks in the sector. Insurance versus Stoxx 600. On the verge of breaking through a 20-year resistance level. CAC 40 versus DAX 40. Historically, the DAX has outperformed the CAC over the long term. But in the short term, this ratio appears to be forming a diamond or rounded bottom pattern, suggesting the CAC could temporarily outperform the DAX. US markets. Small mid-caps versus large caps. A well-defined rounded top formation. If the 0.64 level holds, small and mid-caps could become attractive again. But if it breaks, large caps remain the safer bet. Growth versus value stocks. For the last 10 years, growth stocks have outpaced value stocks. Maintaining support above 1.85 is key. Energy versus S&P 500. Energy stocks are about to retest their early 2022 breakout level. Healthcare versus S&P 500. The ratio is approaching a critical support level, coinciding with an important balance line. Materials versus S&P 500. Near its lowest level in 25 years. Contrarian investors should take note. Technology versus S&P 500. Technology has reached a 25-year high relative to the S&P 500. 0.37 is a key support level to watch. Gold versus Dow Jones. Gold has surged in recent years, yet, relative to the Dow, its movement has been less dramatic over the last decade. Short-term, important resistance at 7.58. Long-term, key level at 17. A breakout here would be a dream scenario for gold bulls. Commodities versus Dow Jones. Recent weeks has seen renewed interest in commodities, fueled by a breakout from a falling wedge pattern. This could mark the beginning of a bottoming process, with a rounded bottom formation taking shape. Contrarians may want to enter now, while trend investors should wait for a move above 0.32 to confirm momentum. In the ever-evolving financial landscape, thorough analysis is essential. Join us for our weekly insights to navigate the complexities of the market with confidence.